Hook and promise. Hey everyone, welcome back to the Capital Breakdown. Here's a question to kick things off. Once you hit $10,000 invested, how fast can your money really start working for you? It sounds like a milestone, right? But beyond just a number, that first 10 can set the stage for your financial future if you know how to approach it. Today, we're breaking down a simple, clear blueprint for new investors aiming to reach that first $10,000 and understand what happens next. By the end of this episode, you'll get not only the what, but also the how and why behind your first tank invested. No jargon, no hype, just solid, practical insight so you feel confident taking those next steps. The problem or confusion. So why is the first tank such a big deal? Well, many new investors get stuck in place, feeling overwhelmed or unsure how to start. You might hear phrases like invest early, buy stocks, or diversify, but what do those really mean? Imagine you're trying to save for a trip but only know that you should save. Without a plan, it feels like tossing coins in a fountain, hoping for magic. Or maybe you start buying a handful of individual stocks because a friend mentioned one, only to see the price bounce around wildly, causing stress and second guessing. That confusion and lack of clear guidance often leads people to delay investing altogether or jump in without a roadmap, risking frustration or losses. Core concept explained. Here's the heart of it. Investing your first $10,000 is like building a sturdy bridge between where your money is now and where you want it to be in the future. Think of your money like water flowing through pipes. At first, you're just filling the bucket, but once you've got $10,000 invested, you can start channeling that water to work for you, growing over time with compounding. Key terms to keep in mind. Diversification means spreading your money across different pipes or investments so one doesn't dry up your whole flow. Index funds or ETFs are like big buckets holding lots of companies, reducing risk by not putting all your eggs in one basket. The goal: to build a steady, reliable flow rather than chasing quick bursts. Core concept explained. Continued. Let's deepen that analogy. Imagine you're building roads for your money to travel. Individual stocks are like single-lane roads. They might get you somewhere fast, but traffic jams or accidents can slow you down. A broad index fund, meanwhile, is more like a multi-lane highway, smoother and more predictable over time. And bonds? They're like the safety railings on the side, offering some protection if things go off track. Understanding these basics gives you a mental map to navigate investing without feeling lost. It's about balance, patience, and setting realistic expectations for how money grows. How it actually works now. What's happening behind the scenes when you invest that $10,000? When you buy shares of an index fund, you're essentially pooling your money with thousands of other investors. Fund managers take that pool and buy pieces of many companies across the market. Brokers are the middlemen who help you trade those shares, while regulators oversee the whole system to keep things fair and transparent. Your money moves from your bank account into the market, and the value of your investment fluctuates based on company performance, economic conditions, and investor sentiment. Keep in mind, there are fees involved, like expense ratios for funds or commissions from brokers, which can chip away at returns over time. So knowing what you're paying for is important. How it actually works. Continued. Plus, it's key to remember that markets don't move in straight lines. Prices go up and down daily, and your investment value will reflect that volatility. The good news: over long periods historically, markets have tended to grow, but past performance is never a guarantee. That's why understanding the flow of money, the role of different players, and the impact of fees helps you stay grounded. The Capital Breakdown always emphasizes that investing is a marathon, not a sprint. Knowing this infrastructure removes the mystery and helps you make informed decisions without feeling like you're gambling blindfolded. Simple, concrete examples. Let's bring this to life with a couple of examples. Imagine Jane, who starts with $100 a month into a broad market index fund. Over time, her contributions plus the fund's returns work together, growing her investment steadily. She experiences some ups and downs but stays consistent, watching her account inch toward and eventually surpass $10,000. Now picture Mike, who puts that same $10,000 into a single speculative stock, hoping for a big jump. The stock's price swings wildly, some days up, others down, creating emotional roller coasters. This example shows how the mechanics differ. Regular investing smooths the ride, while concentrated bets can feel like a bumpy roller coaster. Simple, concrete examples continued. Jane's approach is about steady contributions and patience, letting compounding gains work quietly in the background. Mike's is riskier and more volatile, requiring nerves of steel and a clear plan for when to hold or exit. Neither approach is inherently wrong, but understanding the emotional and financial mechanics helps you pick what fits your comfort level and goal. This is where knowing your own risk tolerance and time horizon truly matters, and why the Capital Breakdown encourages you to think beyond quick wins towards sustainable growth. Risks, traps, and common mistakes. Speaking of risk, let's talk about where many new investors stumble. One common trap is chasing the latest hot stock or sector, which can lead to concentrated portfolios that swing wildly in value. Another is using leverage or options, tools that can multiply gains but also amplify losses, sometimes dramatically. Without experience, these strategies can backfire fast. Then there's impatience, expecting overnight success and panicking during normal market dips. Remember, volatility is normal, and markets reward patience. A final pitfall is neglecting to diversify. Putting all your eggs in one basket can expose you to unnecessary risk. The key takeaway? Approach investing with realistic expectations, a long-term mindset, and a diversified plan. Risks, traps, and common mistakes continued. Also, beware of fees and taxes eating into your returns. High-cost investments or frequent trading can erode gains over time. And don't forget about your emotional reactions. Fear and greed are powerful drivers that can lead to poor decisions. By understanding these risks up front, you're better equipped to stay calm when markets fluctuate and avoid costly mistakes. The Capital Breakdown stresses that knowing what you're getting into, combined with solid research and a clear plan, helps you navigate the investment journey more confidently. How to think about this tool now. Let's zoom out and place your first $10,000 invested into the bigger picture of your financial life. Investing is just one tool in your toolbox. Before diving in, it's smart to have a budget, an emergency fund for unexpected expenses, and clear goals. Whether that's buying a home, funding education, or planning for retirement, your investment strategy should align with these priorities and your timeline. For example, money you might need soon usually shouldn't be exposed to market ups and downs. By thinking about investing as part of an overall plan, balancing, saving, spending, and risk, you set yourself up for greater financial control and peace of mind. How to think about this tool continued. Remember, investing isn't about timing the market or chasing trends. It's about steady progress toward your goals. Your first $10,000 is a milestone, a foundation to build on over years or decades. And as you grow, your strategy may evolve. That's perfectly normal. The Capital Breakdown encourages you to revisit your plan periodically, stay informed, and adjust as your life changes. It's a journey, not a destination, and with the right mindset and tools, your money can become a powerful ally over time. Recap and educational disclaimer. All right, let's wrap this up. Today, we covered why your first $10,000 invested matters, It's the bridge to putting your money to work through steady, diversified investing. We broke down key concepts like compounding, diversification, and the roles of different market players. We also talked through real examples, highlighted common risks and mistakes, and placed investing within the bigger picture of your financial life. Remember, this episode is all about education, not personalized advice. Always do your own research and consider chatting with a qualified financial professional before making decisions. Thanks for hanging out with the Capital Breakdown today. Keep learning, stay steady, and I'll see you in the next episode. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.